When reading accounting, you're going to allows for doubtful date or doubtful date. You're going to take care of that. Notice. Have you done such kind of stuff? Yeah. Direct write-off. Do you remember anything?
Yeah, I think the complete disregard will be bad.
Very bad. Yeah.
So they consider that there was.
Yeah. Then we do the direct write-off method. The company itself has looked at all the angles and I should say how has it been. You're right. So you write this. You write direct write-off method. Direct write-off method. Direct write-off method. So you write the direct write-off method. The direct write-off method. The direct write-off method. The direct write-off method records bad debt expense. So the direct write-off method records bad debt expense only when an account is judged to be worthless. Only when an account is judged to be worthless. Then after the customer has been considered that he may not be able to pay back or he may not be able to pay for the service or the goods that he took from us, that's when we say and we can take him off out of the books or we may consider him as a bad debt. With a right. So here you continue. The allowance method records bad debt expense. The allowance method records the bad debt expense. The bad debt expense by estimating and correctable accounts. By estimating and correctable accounts at the end of the accounting period. By estimating the uncorrectable exit account at the end of the accounting period. At the end of the accounting period. Easy, right? Now let's write this. Write example under direct write-off method. Example under direct write-off method. So you write under the direct write-off method. Under the direct write-off method, bad debt expense is not recorded. Bad debt expense is not recorded until the customer account. Is not recorded until the customer's account. Is not recorded until the customer's account. Until the customer's account. Till the customer's account is determined to be worthless. Determined to be worthless. Full stop. At that time, at that time, the customer's account receivable is written off. So like e.g., assume that $4,200 account receivable, $4,200 account receivable from DL Rose has been determined to be uncollectible. The interest write-off of the account is as follows. So what you do there is, that now we are stating, or we have judged that customer, you will not be able to pay for the amount that is owing our company. So what you do there is that to account for that, you need to debit bad debt expense account. With $4,200. You're there, right? And you credit account receivable. And in this case, this account receivable is nothing but what? DL Rose. 4,200. So you write big account receivable written off. So that means we have taken it off our accounts. We are sure, or we know that the customer will not be able to pay us back. So in this case, that means this one is our bad debt. It's a loss to us. That's why we are taking what? The bad debt expense account. Are we together? Alright. Let's proceed. Right. What happens if an account receivable that has been written off is later corrected? So the usage is no longer in our record, and we have recorded as a loss to the part of the business. So the question now, let's say, customer can agree of not being here. So the question is, how are we going to treat that? If customer comes to say, I'm coming back to pay, how are we going to do? System Sagai, and if we have recognized we fail, we are on the losing side. The customer we have not valid here. Yes, Yvonne. Any idea? So if the customer comes back and says we would like to pay this, since we already reported it's a loss, then what we need to do is we need to reinstate it. We'll reinstate it in such a way that we should bring it back to the situation where the business is expecting to receive from the customer. And later on, we should also take the time when the customer is exactly paying us. 3 months. So what we'll do is to reverse this. Then we'll debit the account receivable with the customer and we'll credit the budget expense account. And when the customer has actually paid us, then we will debit the cash account and we'll credit the customer's account or the account receivable account. Let's try this on that. Have you got what I said? Okay, let's write. Probably you may get it much simpler when we have read that. So right, I'll say what happens if an account receivable that has been written off is corrected. So there, right? In such cases, the account is reinstated. In such case, the account is reinstated. Such case, the account is reinstated. The account is reinstated by an entry. The account is reinstated by an entry that reverses the right of entry. So you reverse this. That is restated by an entry that reverses the right of entry. Full stop. The cash receipt in payment is then. The cash receipt in payment is then recorded as a receipt on the account. Is then recorded as a receipt on the account. Is then recorded as a receipt on the account. You there? So the thing you like to illustrate this. To illustrate this, assume that the DL rows account, assume that the DL rows account of 4,200 written off on May 10, written off on May 10, written off on May 10, written off on May 10 in the preceding entry. Is later corrected on November 21. 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 Full stop. The reinstatement and the receipt of cash. 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 The reinstatement and the receipt of cash is recorded as here, right? So in this case, what we are looking at is we have said we have written off and now we would like to bring back. Then we'll look at two scenarios or two situations. Where the first situation is the customers come to you to say he's going to pay back the amount that he owes you, that you already wrote it off, right? So you restate it. And in this case, what you do is you debit account receivable with DL gross 4,000. That is 4,200. And you credit bad debt expense account. Bad debt expense account. And this bad debt expense account, the very same amount, 4,200. So here, you write the restatement made B, restatement made. Now in this case, you have just received a notification that the customer whom you took off into your record, he has come to say you pay the amount, right? So when the time he has actually paid, that means you've been debiting what? Cash account with 4,200 in credit account receivable. The account receivable GL gross 4,200. So you say B cash received from GL gross. That's what it means. So we have actually reversed the transaction or the bad debt back into correct room to the time that correct was actually being received. So in this case, most of the time, all we need to do is we should be able to see if we are trying to reinstate or to bring back, we should be able to know with drama to render drama say many things like on the right off or we're receiving fashion. So that we should be able to guide ourselves when it comes to reporting, so that our reports include things that are important for material. So let's write this. You write this on that. Alright, let's write this. So you write the direct write-off method, the direct write-off method, the direct write-off method, the direct write-off method is used by businesses the direct write-off method is used by businesses that sell most of their goods or services. That sell most of their goods or services. These are businesses that sell most of their goods or services for cash. Most of their goods and services for cash, and accept only MasterCard or Visa. And accept only MasterCard or Visa, which are recorded as cash sales, which are recorded as cash sales, which are recorded as cash sales, which are recorded as cash sales. Full stop there. In such cases, receivables are a small part. Such cases, receivables are a small part of the current assets. And any bad debt expense, would be small. Examples of such businesses are restaurants, a convenience store, and a small retail store, with the rent. So that's under direct write-off method. Do I have questions from you where you are probably not getting what it means, or is it understood? Yvonne, have you understood? Alright. Let's go to the second. You write the allowance method for uncollectible accounts. The allowance method for uncollectible. So there you are. As mentioned, earlier, the allowance method is required. By generally accepted accounting principles. generally accepted accounting principles. Generally accepted accounting principles for companies with large accounts receivable. For companies with large account receivables. Full stop. As a result, most well-known companies such as Pepsico, VX, General Electric Company, use the allowance method. Okay, let me go through that one. We know the allowance method. What it is, you are unsure as to who exactly will default or who exactly will not be able to pay you. So in such a case, what it is, you look at the trade, how has been the trade like, and from the trade itself, you should be able to determine what could be the next activity or what could be the next situation. So you make a prediction, say, okay, with what we see, we feel like probably such sales may not be corrected. So you just make an assumption. You assume from all the accounts receivable sales, as probably so much accounts receivable may not be corrected. So in this case, there is no individual customer whom you directly know that he has defaulted or he has failed what to pay back. So that's why I'm winding up. So as discussed in the preceding section, the direct write-off method records bad debt. The direct write-off method records bad debt expense only when an account is determined. Records only when an account is determined to be worthless. In contrast, as explained, the allowance method estimates the allowance method estimates the account receivable. The allowance method estimates the account receivable. The allowance method estimates the account receivable. Estimates the account receivable that will not be collected. Account receivable that will not be collected. And record bad debt expense. and record birthday expense for this estimate, and record birthday expense for this estimate, and record as I said, birthday expense for this estimate at the end of the accounting period. At the end of the accounting period. Is that right? Based on this estimate, based on this estimate, based on this estimate, based on this estimate, budget expense is then recorded by an adjusting entry. It's recorded by an adjusting entry. Right. So just as I already said, in this case, of all the sales that you're likely to make, you just make an assumption. My sales are based on the trend. We are likely not to collect them. So you don't have a specific customer who is paying, but you just would say this could be the amount from the collectibles that may become and collectible. So here is example. Write example. So now next meeting we'll pick on that example. We read. Yes, Yvonne. Jose. This is here 4. That's 9.